The market is constantly moving within a 3-day cycle and building these certain types of templates that even if you can just identify 4 or 5 of them, you'll consistently be able to find trades day in and day out and week in and week out. So in this video, we're going to go through a couple of the different types of templates, whether that be trend trades, reversals, some of the mistakes that you could still be making with the 3-day cycle, and helping you to identify the different types of templates and what you should really be focusing on. Additionally, if you're still struggling with finding day one within the cycle or understanding the rules for the cycle, I've got plenty of videos here on my channel, as well as a link to this slideshow down in the description below, and also a free Discord channel where everybody is sharing information, where I go and post a lot of information as well. The first template that we're going to be looking at is the 3-day rectangle, and usually this is going to be where day one of the cycle dumps down or goes into consolidation. Day 2 of the cycle remains within the previous day's consolidation. Day 3 of the cycle goes on a range expansion, basically breaking out of that rectangle and completing a measured move of that rectangle. And sometimes it will look like a 4-day rectangle. This is not meant to be taken completely literally. Sometimes it'll dump down on the first day, and then you'll have kind of like that's the first day, and then the second day, and then the third day, and it's still inside of the rectangle, and you're wondering when it's going to actually break out. And then on the fourth day, you get your big move back up. It's meant to, like I said, not be taken completely literally about the 3-day rectangle. Sometimes you can add that extra day in there. Sometimes, like I said, it looked like a 4-day rectangle. So some of the price action that we're looking for is for a squeeze higher on the day itself that I'm looking for the breakout. I'm going to be watching structure on the 5-minute chart and on the 15-minute chart and looking for a squeeze. Higher highs, higher lows, lower lows, lower highs, depending on the direction that the breakout is occurring. I'm looking to take entries on the first pullback into the EMA after the higher high or the lower low is formed. I'm putting my stop loss above or below the trap volume area, which is usually going to be above or below that second push, either into the low or into the high. So if you have a squeeze pattern, you're going to have 3 pushes down into the low, and then you'll get your higher high. And then when it comes back down, it could be 3 bars, it could be 3 legs, some kind of 3 push pattern, something like this. And then now we have a 3 push pattern. I could say, okay, well, this is where the trap volume is going to be. This is where most traders are taking action in the chart. And then I get my reversal, and I actually take the signal bar, the entry bar. I'm going to put my stop below that level, not necessarily all the way back down at the low, because sometimes that's really far away. But usually this is a good place to put it because that is where they're not going to come back to. And it really should just go vertical from this point. Sometimes I can look for bear and bull trend channels. And these channels, the most ideal ones, are going to be very tightly wound. It could just be a series of bars where there's not a lot of overlap in the bars. Let's say it's a bull trend channel. The bars continue to make higher highs and higher lows, and sometimes they'll push down and try to make a lower low, but then a lot of times it'll just be like a pin hammer and the bars will continue to go higher. This is showing that the market is dragging in one direction. They are dragging the shorts. Anybody who's trying to go short in that channel is getting trapped, and it's basically coiling in an upwards direction for the blow off, or depending on the direction, it could be coiling in a downwards direction for the blow off to the downside. Whenever it breaks out of the channel, I'm going to put a 1-bar stop on that so that if it were to come back up and tag me out, that'll be fine. I'm really trying to wait for the channel. Once we're in the channel, I like to wait for the stop hunt back up outside of the channel, and then once it falls back down in on a lower time frame, that's usually where I'm going to get in. And then if once it breaks out to the bottom side of the channel, if I have not entered already, that is my opportunity to do so. This is a pretty recent example on NQ. This is a 15-minute chart from October 1st, where the market had made a day 1 of the 3-day cycle. They broke out at the high of the current week and failed. This actually turned into an outside day where they've hit both sides of the range, and it also turned into a breakout day. They broke out of the previous day's low. But this was the beginning of the 3-day rectangle. A big spike down, a big spike back up, an entire day sitting on the inside of that consolidation. So now we have the first and second day of that rectangle, the third day still being on the inside of that. And this is where the valid price action starts to kind of come into play. We're getting higher lows put in place, and it's coiling sideways as it is putting in these higher lows. And we're making higher highs on the day over here, and there's that little channel that I'm talking about or referring to. And notice how it keeps dragging higher and higher. Even the down close candles are ascending, and then we get the explosion probably off of news. So whenever I'm looking for these trades, you can go down to a lower time frame. This is a 5-minute chart of the same day, the 1st of October. And this is exactly what I was talking about. This is how I determine whether or not the market is actually setting up appropriately for me to enter into the market or enter into the trade. Now, me personally, I am not ever going to get in before the news, but if I have a larger setup in play, I can wait for the first bounce opportunity where I already have a larger setup, which is that 3-day rectangle, the 3-day cycle. And I would be looking for that long trade as it is breaking out. This was the news bar that completes the pattern, and you don't get any sort of pullback to allow you to get in. Maybe on a lower time frame there was opportunity, but at least here on the 5-minute chart, there really was not. Let's talk about from left to right leading up to the trade. So this is Asia, this is London, and then the New York session. The Asian session has made a higher high and pulled back and gone into consolidation, and then broke out in the gap time, and then gone into this channel. Okay, this is a bear trend channel, and every time they spike back down, it immediately takes it away. Every time they spike back down, it immediately takes it away, and they're making higher lows as the market is dragging higher. That's all really good stuff, and then it breaks out and explodes, and there's no opportunity for me to enter. They even go up 3 levels of rise and complete that before the New York Open, and then you can just look at price action as it is breaking out. This is the previous day's high. They broke out, and then you get this 1, 2, 3, and an engulfment, and then you get your little channel now to come back down. So if I'm looking to go long, this is a good reason for me to not be looking to enter into this long because the market is currently breaking back down. Another good 3-day rectangle sort of example. This is gold 15-minute chart on the 4th of October. Now this was an outside day all in one day where they spiked up, they spiked down, and then it basically made a high and a low. So this is the rectangle high and low. Now on the inside of this rectangle, it starts to coil and get a little bit tighter. And on the 3rd day, we start getting lower lows and lower highs, and it breaks down and then pumps back up 1, twice, and a 3rd time, even ending in a bit of a 1, 2, 3 right into the beginning of the New York session. You get your engulfment, and this is where I would be looking down on a lower time frame. I'm going down to the 5-minute, I'm going down to a 1-minute, and I'm going to wait for my pattern to show up. And I can either get in off the first engulfment in the first hour of the New York session, but a lot of times, you know, depending on how the 5-minute chart looks or the 1-minute, I will usually wait for another opportunity where it's that first engulfment, and then maybe it pumps it back up and then gives me a second one. That's usually going to be the best opportunity for me. And the most reliable. So you get your first engulfment here, which could be a little bit risky because you're just selling the high of the day. And then it breaks down below the EMA. And this is usually where I can start looking because we've broken down below the EMA. We've got volume trapped above push 2. And now I can look down on a lower time frame for a good entry. So let's come down here and take a look at what that would have looked like. And notice that coming off of the low of the day, they put in a peak formation low. We get that level 1 rise, level 2 rise, and then coming up into level 3, some of the price action behaviors that I like to look for. One of them is called the 3-push stair step, and this is a 3-push stair step at the high of the day, or a triple top essentially, where we get up to the high of the day. We're in first leg, second leg, third leg, and in that third leg you get this nice little stair stepping action, and then this is where the market has broke down. So we broke down below the EMA, and then this is something I like to call a 1-bar fake out, or a breakout fake out bar, where right after the breakdown they put 1 bar back up, basically trying to get people to trade long back into the high of the day or back up into the high. And then as it is now coming back down, notice the price action, we get the bear trend channel. Very little to no overlap in the bars. They just keep dragging lower, and then the breakout. Now I like to sell the break of these breakout fake out bars at the close. So this bar broke below that bar and closed. So this is a great opportunity to enter in on that bar. We're also at closing price. So that's really good. And then targeting, of course, the low of the day. And you can even look for an expansion of today's range if you want to do that as well. So this is the breakdown. This is the first pullback into the EMA, breakdown, second pullback into the EMA, and then the rectangle follow through. Basically breaking out of that rectangle and expanding the range to the downside. Another 3-day rectangle opportunity. This is the NASDAQ 15-minute chart from September 16th of 2024. Now, this is going to be one of those things where and you're going to see it later on in the mistake slide where Monday has broke out of Friday's low and failed. And then Tuesday has broke out of Monday's high and failed. This is basically a peak formation low, peak formation high. You've got day one repeating 2 days in a row, but at opposite ends of the current week. So this can start to build a rectangle for this kind of trade setup. So we get day one. Now this day over here could have been the breakout day. Sometimes you'll get this pattern day one, and then this day over here, because of peak formation low, peak formation high, and then Wednesday could be the trade. In this case, it was not the trade, so we can just go over to the next day. That rectangle remains valid. And then looks like the trade ended up happening in the Asian session and coming into London and even into the New York session. Whenever you get up this high and they just keep on dragging higher and higher and higher, this is usually going to be a no-go for me. But I did include this example just because of the peak formation low, peak formation high template. So this would be kind of a no trade for me. Yes, it probably would have worked out and I would have had a winning trade. However, this is not usually the template that I'm looking for in the New York session. I'm trying to get in somewhere either in the rectangle or just as they're breaking out of the rectangle and taking the trend trade. So that way my reward opportunity is much greater and much larger compared to this, where, you know, it kind of has that it could reverse at any time feeling to it. Like I'm selling up kind of high, buying up kind of high. I would prefer to get in down a lot lower, but the template is still valid, so I did include it as it is a fairly recent example. So let's come down to another 3-day rectangle example. Now we had, for some context, this was a fairly large dumping day from Tuesday. And then Wednesday put in a peak formation low at the low of the current week. That's restarting the 3-day cycle. This is day one. And then we get a day two, basically a consolidation day. That can be the second day of the rectangle. And kind of like in the previous example where the rectangle was 4 days long and on the fourth day, it was the breakout. This is kind of a 3-day rectangle, but in reverse, where on the third day, it does break out. So day one of rectangle, day two of rectangle, day three of rectangle, except on this third day now we're getting the follow through, we're getting the breakout. So Asia makes a lower low, so that can start to build the story. Okay, we're making lower lows and lower highs. Market structure's telling me market go lower. We get another lower low in London. Now that puts, you know, money sitting at the high of the day. So if they go back up to the high of the day and reverse aggressively, that can set up the framework for our trade. And again, this is a 15-minute chart. So notice here the engulfment on a 15-minute chart was at 9:30 at the high of the day, peak formation high. This engulfing bar went lower than the left side or the first leg of an M, which is all really good stuff. So let's go down to the 5-minute chart example and take a look at what sort of details went into this. So remember, London had made this lower low, gone into consolidation, and then it breaks out of the consolidation for the first leg of the move back up. First leg outside of consolidation. So it's a market only does three things. We're breaking out now. We're starting to trend back up into the high, but it could just be a pullback. And whenever the market comes out of consolidation, one of those price patterns to look for is a 3 push pattern. There's lots of different 3 push patterns. This could have came out in 3 bars. And in this case, it came out in more of a stair-stepping fashion. So this came out, breakout, push 1, breakout, push 2, breakout, push 3. And then in this last leg, it's gone into consolidation between the high of this bar and the low of this bar, which is very important to understand because usually the strong, really good reversals is going to break below the left shoulder or the left leg of the M, the first leg of the M, excuse me. So this break up here, the pullback, that's the second part of the M. The second run into the high is the right side of the M, and this is like the right side of the M coming back down. So up, down, up, and then this engulfing bar that runs lower than here. That is a good first place to enter. Maybe with smaller size, this bar is pretty large, but ideally, first pullback into the EMA. This is that breakout, fake out bar, one bar going back up into the high, and then maybe on a lower time frame or just waiting until we get the follow through bar to enter in the rest of the way. Really great trade, really good price action on this. Breaks down, pulls back, and then we get the follow through almost immediately after. That's how it should look. This is, like I said, a 5-minute chart on the 16th of September for you to go check it out yourself. So those were some of the 3-day rectangle examples, and those are really just for you to go back and study the charts yourself. Most of those examples were on the NASDAQ, so it doesn't matter what pair you're looking at. You could be trading Forex, you could be trading indices, anything like that, gold, oil, any of those. It really doesn't matter. I just happen to use mostly those NASDAQ examples. So now we're going to go into some of the trend examples and the different types of templates you can see for a good trend trade using the 3-day cycle. So day one of the cycle is going to be that peak formation day. Day one of the cycle could also be a first red or a first green day. Day one of the cycle could also be a breakout day. And remember, Because the market only does three things, keep that in mind. If it's a breakout day, is the breakout going to succeed? Is the breakout going to fail? Those are some of the questions you really need to be asking yourself and projecting those levels across. Now, day 2 of the cycle could become a consolidation day. It could become another breakout day. And I'm going to, go back to what I just said about day 1. It's going to either breakout trend, breakout reverse, or stay in a trading range. And in this case, if it's on day 2 of the cycle and we have a breakout, I need to project that level across and see, hey, is this breakout going to succeed? Is the breakout going to fail? And watch price action on the day that I'm looking to take the trade, to watch structure and to watch within my session whether or not I actually have an opportunity. Day 2 of the cycle could also be a pullback day. So if day 1 of the cycle was a breakout day and then day 2 kind of starts to come back down, but we're still in breakout, that could be like a breakout pullback sort of template where they've broken out of a previous day's range. They use the next day as a consolidation day or a pullback day. And then on day 3 of the cycle, we may now get our actual trend trade. So day 3 of the cycle, I'm going to look for a low of day, high of day trend opportunity. If we're going up, I want the low of the day. If we're going down, I want the high of the day. And with that being said, just because I'm not directly at the high of the day, if the trade's coming off of the high of the day, like it's already in progress, that's kind of what I mean by being at the high or the low of the day. I want to be as close to the high of the day as I can if I'm selling. So maybe at the high of the current session. Or at the low of the day if I'm buying, or at least as close to the low of the day as possible. So let's take a look at this template. This is a 15-minute chart of the NASDAQ October 26th. This was day 1 of the 3-day cycle. We got an outside day. They spiked both sides of the range, and it was also a breakout day to the downside. And this is what I was talking about, where they could use the next day as kind of a pause day or a pullback day. So this is a breakout and then a pullback day. And then now that brings us to day 3 of the cycle. And I'm sitting here trying to figure out, okay, is it going to go up? Is it going to go down? What kind of template am I in? Well, we've been making higher highs and higher lows. Maybe I should be looking for the long trade. And you just have to wait and see what kind of day is presenting. So in this case, maybe there was a long opportunity in London because of the facts that we just discussed. We're making higher highs and lows on the day itself. It's pulled back and then it's going higher. You could have had, solid beliefs that we're making higher highs and lows, and there's trend opportunity in London. Now, of course, this is an American index, so probably best to wait for New York anyways. However, once we get to the high of the day and it goes into consolidation and you get a peak formation high, and then the market starts making lower lows and lower highs, now your thesis can change and you can look for the other option, which would be the trend opportunity based off of day 1, day 2, day 3. Day 1 was a breakout day, day 2, a pullback day, basically the pump, and then now we can look for the dump. All right, so we get a lower low, lower high. Timing, of course, plays a lot into when these trades should be taken, especially with an American index. Right, this is 9:30, market open, and it's set up perfectly for that opportunity for the pump and then the dump sort of template. So let's come down and take a look at the 5-minute chart. What this would have looked like on the day itself, right before the entry is taken. So we're making higher highs and higher lows in London, and this is the low based off of, this is a higher high. They pulled back in 2 bars. These 2 bars went lower than the bar that made the higher high, right? So this wasn't a 1-bar range. They pulled back significantly, which is good. And then we made a second higher high, which confirmed this as a swing low. All really good stuff. We're still making higher highs and higher lows until in the gap time, they start making lower lows. So now that we've made a lower low, I can look for a lower high to present and wait for that 9:30 time. So we've got the lower low in place. And then the way that the market pulls back coming into 9:30, they've came off the low in burst 1, and burst 2, and burst 3, up, down, up. And then that bar is the engulfing bar running back down to complete the M for the peak formation high here on a 5-minute chart. And we're right at closing price, which is all really good because that means that this could all become trap volume at the high of the day. And then this is expanding now, obviously back down towards previous day's low. And if you look up here at the 15-minute example, back down to where that pump originally began, which was the low of Thursday. This is a good trend example on oil. This is June 6th of 2024. There's plenty more recent examples for these trend 3-day cycles, but this one just caught my eye, so I used it. All right, so day 1 of the cycle, this was a Tuesday. They broke down below Monday's low, and then on Wednesday, it came right back up. So if you're still confused about finding day 1 of the cycle, like I said, I've got plenty of videos, but this was a breakout of Monday's low, an opening range breakout that has now failed on the following day, Wednesday. So this is day 1 of the cycle. Then we have day 2 of the cycle. hey, day 2 of the cycle has also turned into a breakout day to the upside. So now I can project this level across and ask myself, is this going to succeed or is this going to fail? So on the day itself, I need to be watching structure. I need to be watching the template for the day and the timing and where we're at within the template in order for me to look to take this trade. So if you were to project this across, just notice how they're spiking back down into that, and then eventually it does continue to go higher. So let's come down to a 5-minute chart, which is going to be a decent entry time frame. If you like the 1-minute chart like I do, great, you can use that. But 5 is, of course, just fine. So on the day itself, we're making higher highs and higher lows. Now, this did break down and make a lower low, at least on a 5-minute chart. But then they come back and they make the higher high. So after they've made the higher high, realistically, what this should have done is this lower low, higher high, when they hit the high, this should have followed through back down through the low and broken down and continued to make lower lows and lower highs. That is what should have happened based off this pattern, but it doesn't, which gives you a ton of information. So the failure to make another lower low, and then it starts making higher lows, higher high, higher low, and then this is that little squeeze pattern, down, up, down, engulfing bar, and then almost kind of like a micro inverse head and shoulders. That's like the left shoulder, that's the right shoulder, and then that's the bar that completes the pattern over here on the right side of the V. So this is a good thing to watch for. Hey, you know, we made this lower low, so I'm really not too sure about the short trade or the long trade, excuse me. So maybe you could have taken this short trade after it broke down over here. And then once it fails to make a lower low and they start doing something like this, where it just can't get down. Look, they've jammed down once, twice, and 3 times, making higher lows, and they're starting to make higher highs. That is good price action pattern for the long opportunity. Just a little note to hopefully help you out. And then, of course, this is a trend trade in the direction of that breakout from the previous day. So they broke out, they pulled back, and they continue to trend with my face in the way. So there you go. And that pretty much covers the trend trade templates. If you get a breakout day, is the breakout going to succeed or fail? If it's succeeding based off of price action, for example, like we just saw, they were making higher highs and higher lows. They were making higher highs and higher lows on the day itself. And then when it pulled back, it was doing it in the timing window. How did they pull back? They pulled back in 3 pushes. And then we got an ascending triangle and a breakout for the entry for the trend trade. So those templates, they can look slightly different, like there's different variations of the theme, but the idea remains exactly the same. If we're, for example, breaking out to the downside and then they have a pullback day, then I can take a trend trade in the direction of that trend. If we have a breakout day and a pullback to the upside, breakout, pullback, and the breakout succeeding, I can now go and take the long trade. But what about for reversal trades? Maybe we're moving in one direction for 3 days or something along those lines. So day 1 of the cycle, a large dumping day or a large pumping day, it basically is going to bring the market up high or down low very quickly. This is where all the reward comes from, because in a reversal trade, it's going back for the money at the other side of a range. So if they bring it down very quickly, and then we're sitting down here consolidating and we get like a nice day 1 or day 2, and then now we go to take our trade over here on day 3, this is where our reward comes from, because that's the high that they're going back for. So now we've got all of this space to get back up to where that high was formed. And that is why these reversal trades are so good, in my opinion, when they do show up the correct way. And usually they're going to go back to that level very quickly, very aggressively, which is why it's a good parabolic trade. So day 2 of the cycle, same thing as the trend trades. They can be consolidation days. You could also have a first red or a first green day. And then day 3 of the cycle, peak formation should already be in place or be put in place prior to the session that you're trading. And the same as every other trade that I take, all of my entries are always the same. I'm looking for squeezes, higher high, higher low, or lower low, lower high, or a channel, a bear channel or a bull channel with some different characteristics of the channel that I like to see. Tightly wound, dragging behavior. Every time they try to go back down, it immediately takes it away. Or if the channel is going down, of course, you just reverse that. Every time it tries to go back up, they immediately take it away and continue to drag lower. Tightly wound and ready to explode. All right. And then the location of these that I'm looking to take the trade from is either from the high of the day or the low of the day. They're working the high of the day on day 3 and it breaks down. I could take the first pullback into the EMA, or if I'm at the high of the day in my session and it breaks down, then I can take that as well. Second leg M, second leg W. So if the market is broke out of previous day's level, day 1 or 2 of the cycle, outside of previous day's high or low, I make sure to project that level across like I was talking about in the trend trades to help tell the full story. Maybe I have space just to get back down to that breakout level, and that is my reward. The market's breaking down and going back for that level. That would be the pump, and then the dump would be the dump back into the breakout level. Or maybe we've broken out of a previous day's high, I project that level across, and we make a lower low back down, and then the breakout of that high is failing over the course of 2 days. The market is either trending, reversing, or staying in a trading range. And this is exactly what I was talking about on that previous slide. So again, day one of the cycle, we have a Tuesday that breaks below Monday's low, puts in a peak formation low at the low of the current week, and reverses the next day, which also turns into a breakout day on Wednesday. This is day one breakouts to the upside. It closed outside of breakout, so you can project that level across. And then on the day itself, what has happened? Well, we're making lower lows and lower highs and a pullback, and the same exact thing applies. We get the lower low. How does the pullback happen? Does it happen in 3 pushes? What time is it? Watch price action on the day. This is a 15-minute chart of the NASDAQ on July 31st. So day one, peak formation day. Day two, breakout day to the upside. Day three, they're working the high of the week and they break down. Okay, so maybe we're going to get back to, at minimum, the breakout level to retest those breakout traders and things like that. In this case, it went further. Great. So I can measure from here to here and look for an expansion of that range back down or just go back down towards the peak formation. And here is the 5-minute chart of the one that we just looked at above. And this is going to be on the day itself of the NASDAQ. So we had the Asian session, then we have London and then New York. Asia puts in a high, and we start making lower lows and lower highs in the London session. Basically, the market breaks down in London and then pumps back up. So this is the peak formation at the low of the day, coming off of the low of the day. It pumps up once, it pumps up twice, and then in the New York session, hits it one more time. So this is a nice little stair-stepping motion, and the timing of this is perfect as well because right into the New York Open. So we have 1, 2, 3 back to the high, and then a 4-bar reversal, up, down, up, and then the reversal bar back down. So you can either take this bar or you can take the, after they break back down below the EMA, there's that 1-bar pullback, wait for them to reverse. So once they engulf that 1-bar pullback, that's another place that I really like to enter. That's the first pullback into the EMA entry. And then, of course, targeting back down where we just talked about. You can target the low of the day. Of course, that doesn't really offer a lot of risk to reward, so it's best to target a... Here's another one where day one of the cycle, high of week reversal. Okay, they broke out, it failed. You get day one of the cycle. Day two of the cycle is the one that brought the market down super low. So this is the previous day's low, and it broke out of that and went down super duper far on Wednesday. And that's fine. It could have just kept going on Thursday, but it didn't. Instead, it broke down into a rectangle down low and then puts in higher highs and starts the breakout process back up to the upside, or the reversal process. And where is this going to go? Again, back for the money, previous day's high of the previous day. We've got lots of space to get back up to that breakout level. Similar to the thought process on the previous example that we just looked at here, if I get my face out of the way, where we had the breakout level here, and then we're trading it back down to the breakout level. Same thing is going on back down over here, where you've got your breakout level right here that's projected across. We get the breakout, comes down low, goes into a rectangle, and then goes back for that breakout level. You just got a lot further to go on this example. So let's take a look at the 5-minute chart, the price action on the day that could have let you see this and say, hey, this is actually something that I need to click the button on. So this is US 30, like I said, 5-minute or 15-minute chart. And on the day itself, excuse me, this is a 5-minute chart. And I don't know why it says 15, probably because I typed it wrong. Anyways, we've got a higher high in London, and then it comes back down for 1 and then 3. And then now we start making higher highs and higher lows. So we get a high, a higher low, higher high, higher low once again. How do they get back down there? Big push 1, big push 2, big push 3, wait for the engulfment. There's the engulfment. So that engulfment was also right at 9:30, which is perfect. This one little bar in between here is the first pullback into the EMA on a lower time frame, and probably was something that looks a little bit like maybe a like a bear flag or a bull flag, something along those lines. And then, of course, the continuation. Now, it did not go all the way back to that breakout level in the morning session. So again, you can take profits wherever you'd like, or hold on for the larger move, or maybe take some profits and then hold on for the rest, whatever you'd like to do. Just trying to explain the cycle and usually what the setup entails as far as where to target and where I like to enter and what kind of price patterns that I like to see. All right, so those were some good examples for reversals. Again, market brings the market. Comes down real low and goes into a rectangle. Is it going to reverse? I have no idea, but if I watch structure on the day and it starts making higher highs and lows, that's what I'm going to be watching for. Same thing in the short direction. You know, they bring it up high and it starts working the high of the week and breaks down. That's the trade that I'm going to look for. Now, these are going to be some confusing templates that aren't really confusing, but if you're just focused on, well, it's day one of the cycle, and then today's day one of the cycle, and then today's day one of the cycle again, or, hey, that was day one yesterday, but it did this, and now it's day one again. So we're going to talk about some of those templates that might be confusing if you're just focused on the 3-day cycle. So one of those is the 3 peaks, and I joke about this being like a turtle peak pattern where the head of the turtle keeps popping out, and they keep putting it back in the shell. It's just a dumb analogy, but when they keep breaking out to one side or the other and then pulling it back into the previous day's range, this is setting up the market potentially for a 3 days of longs or 3 days of shorts in the market trade setup coming off of the high of the week or the low of the week. And to enter or to identify whether or not it is actually going to set up appropriately for that, it comes back to exactly what we've been talking about for my entry model, which is we get a higher high, higher low, higher high, lower low. Okay, so now I've got the 3 days of breakouts or the 3 days of longs in the market. They've came back down. They've made a lower low. The session hasn't even began yet, or maybe it happened in the first hour of the session. And then they pump it back up in 3 pushes into the EMA or something like that for the trade back down. Now, of course, I have pictures for this and I'm going to show you, but I'm just going to read off what I've typed out here since I did take the time to type it. Example 1, market breaks out and fails at the high of the week on Monday, creating day 1 of the cycle, but then it does it for 2 more days in a row. This is likely a 3 days of longs in the market trading setup, like I just said. Example 2 is the exact same thing as example 1, just in the opposite direction. It could be 3 days of shorts in the market, and then you're looking for a short squeeze. For example 1, I'm looking for a long squeeze, lower low, lower high. And then for example 2, I'd be looking for a higher high, higher low for me to actually take my entry. Peak formation high, peak formation low. This is actually one of the examples that we looked at earlier in the slideshow where Monday had made the low, Tuesday had made the high, and then Wednesday maybe the trade, or it could extend all the way over to the next day. And it actually doesn't matter what days of the week. It could be a Friday, Monday, Tuesday. It could be a Monday, Tuesday, Wednesday. It could be a Tuesday, Wednesday, Thursday. It doesn't matter what days of the week, as long as those peak formations are made at opposite ends of the week. And you'll see what I'm talking about here in a second. So let's come down and take a look at my unbelievably sophisticated Harvard-like drawing. I'm telling you, you're not going to find anything better. All right, so we're looking at this. Well, we had a consolidation over here, previous day's high and low, and then they broke out and it failed on this day. The day ends. All right, so you got a day 1 of the cycle. But then it happens again the following day, breaks out, and then it fails. And you're like, okay, well, I'm going to repeat the cycle, I guess. Today's day 1. And then it happens again on the 3rd day. So now we've got 3 days of them spiking their little price action up above the previous day's high and failing. That's what I'm talking about. So on this day over here, I could say, okay, well, they've done this 3 times in a row. I can look for either one, it's going to blow off in this direction. If they just keep making higher highs and lows, this could be something like this, where it's just pulling higher and higher, keeps on first mousing its way, and then eventually it goes. That could happen, so keep that in the back of your mind. But that's not relevant, really. It is relevant, but it's not relevant as long as they make that lower low. So if you have good rules for structure and you have good rules for market structure to identify the lower low, once that lower low happens, that means that's my trigger to start looking for the setup and say, hey, first action has been completed. Now I need to look for the lower high and the development of that lower high. And how am I going to do that? I'm going to look for the lower high to develop in 3 pushes back up. If they do 3 pushes back up and I get a double top, descending triangle, anything like that, and I get a continuation pattern, I will take that. Okay, let's come down, see if we can't find us an example. Now, the example that I have, I've been talking about all these examples in the long direction. The example I have is in the short direction. Well, it is the long direction, but the other examples I had were in the short direction. This is more for the long example. All right, so this is gold. 15-minute chart, September 5th, 2024. Notice how they broke out of previous day's low and it failed. And then on the following day, they broke down and it failed again. And then it tried to do it again on Wednesday, and once again it failed. So now we have a first green day as well on Wednesday, but we're not going to focus on that. On Wednesday, they made a higher high, which is perfect. Came back down, 3 pushes, boom, boom, boom. Puts us into a rectangular consolidation, a rectangle. And then now we have our breakout. Breakout, first pullback, London, continuation example. Once we get up here, like I said at the beginning of the slideshow, I really don't care for buying up high. Look, previous day's high, we got a lot of room to get back down there. Super risky, not high probability. Could it have kept going? Sure. Is it high probability? No. I want to be in down here, first pullback. That's a good entry, in my opinion. Yeah. Right, and then that other confusing template that I was talking about, Monday, Tuesday, this is US 30 15-minute chart, July 19th, 2024, where they broke out of Friday's high here on Monday, and then it failed. And then on Tuesday, came down, broke below Monday's low. So now we have peak formation high, peak formation low, and you're like, okay, well, that's day one. That's day one. What do I do over here? Peak formation high, peak formation low. I'm looking for squeezes. I'm going to look for parabolic channels, anything like that. So we're going to watch the price action on this day and determine what kind of trade is taking place. We're making higher highs and higher lows. They pull back into the low. And in golf, this is a 15-minute chart. Of course, I'm going to take the entry on a lower time frame. But that's the idea. And then this is going to go back for the money. Again, previous day's high, maybe the high of the week, which in this case, it got all the way back up to the high of the week. This is a fantastic move. But those are the types of templates that I'm looking for. And then, of course, there's still some limitations and some mistakes. This is not a perfect system. This is not meant to be the golden goose or whatever you want to call it, the holy grail. If they're not clear, if the patterns aren't clear to you, just go back and do some more studying. Find these 3-day rectangles, find the dump patterns, find the pump patterns, and take some of the things that I've talked about as far as the ways of identifying the templates. Don't overcomplicate it. If it's a breakout, is the breakout going to succeed or fail? Is it a trend trade or a reversal? That's really all there is to it. Don't get caught up in the fine print. Study the cycles and making assumptions. Just because yesterday was a first green day does not mean the market's going up today. Just because yesterday was a first red day does not mean the market's going down today. There could be other things at play, which really brings me to not studying price action. If you are, just mainly solely focused on identifying the cycles and the signal days and things like that, and you're putting all of the weight on those understandings, you are really limiting yourself and limiting your accuracy as well. And you're kind of just guessing based off of, well, I understand how yesterday formed, so today has to do this. That's definitely not how this works. I'm looking for those previous days to have done something and then using today as a comparison to that. This is what's happened in the past. This is what that is showing me. And then this is what today is showing me. And I kind of compare and contrast the two and then make a decision on whether or not that trade setup is actually forming and actually presenting. Understanding the cycles, but not structure and price action on the day. It's exactly what I just talked about. Make sure you're studying price action. Al Brooks is a really good source for this. You can go and study. He's got plenty of books about reversals, trend trades, all that stuff. Reading Price Action bar by bar, that was my favorite book by him. I've read the whole thing. Love it. Fantastic book to study price action. Usually I wouldn't suggest books, but that was actually a really good one. Hearing the words, the market only does 3 things: breakout, trend, reverse, or stay inside of a trading range, but not really truly understanding what that means. If the market is broken out of a previous day's level, it's in breakout. It's either going to succeed or fail the next day. And I need to look and see and determine which one of those two things is going to happen. If the market is not broke out, this is a new point here because this is separate, but also equally as important. If the market is not broke out, you're on the inside. You have a much higher chance of pricey or choppy price action, and this includes inside weeks as well. If you have a whole week of they have not hit previous day's high or low, and don't take my word for it, go back and look at any week where the whole week did not hit previous week's high or low, you're going to notice that it's a lot more choppy up and down each bar. They're a lot more indecisive. Instead of breaking out and trending, there's a lot of reversals, a lot of wicks and things like that. The price action is just not very clear. And those are those low probability weeks that you should probably just go find a different pair. It's not going to be garbage. This is going to be a 2-part video because if I were to go through and put in all of the examples like I'd like to for all the different types of templates, reversals, trends, peak formation high, low, all the things that we've talked about in this video would probably be like 3 hours long. So I'm going to, in the next week's video, go over each one of these different types of templates with just the examples. I'm not going to go through all the slides with all the typing and all the words on the screens. We're just going to go through only the examples and talk through those and hopefully provide enough examples that things start to stick for you, and maybe I'll say something that gives you an aha moment or whatever. Let me know down in the comments below if this video has been useful to you, and I will see you all in the next one.